The climb in yields is why my next guest says the Fed will be sitting on its hands at the meeting in 2 weeks. For more, let's bring in Jeff Krumpelman, Mariner Wealth Advisors Chief Investment Strategist, and Peter Boockvar, Bleakley Financial Group's Chief Investment Officer and a CNBC contributor. Welcome to both of you. Peter, is it you who thinks they're going to stand pat? I mean, some are arguing the latest spate of data should push them towards doing one more hike, even as soon as that next meeting.
Well, the bond market's done it for them. If you look at where, and let's just take the most interest rate sensitive part of the economy, that being housing, since the July Fed rate hike, the average 30-year mortgage rate has risen an additional 100 basis points. If that's not tightening, I don't know what is. So the Fed, therefore, does not need to shift the Fed funds rate as the impact of the longer end rate rise flows through the economy in terms of its impact.
Yeah, so... And I sort of teased how Jeff feels about stocks, but Peter, are you also in the camp that thinks we're going to be kind of range bound here?
I'm nervous with the rate rise, its impact on the economy negatively, and also multiples that I'm just not comfortable with. Now, there's parts of the market that are cheap, not defined as big cap. The smaller cap, the mid caps are much more attractive. We're tending to be focused on international markets that are much cheaper and commodity stocks.
Right.
But big cap tech, for example, is still wildly overvalued, in my opinion, particularly with the rise in rates that we've seen.
Jeff Krumpelman, that tees you up nicely because I know that in some ways, and maybe in many ways, you agree, and you're looking towards a slightly different mix of stocks. What are they exactly, and what's your sense about what we're learning here?
Yeah, well, as you know, we were outrageously bullish, I'd say, going into the year because we thought folks were just uber negative. We were going to have a recession. We were going to have an earnings implosion. The Fed was going to hike to the moon. Rates were going to go to the moon. And, you know, that just hasn't played out. We have less worse outcomes, better than feared outcomes. And that's why we were bullish at that time. And now we've had this big run. And so, like Peter, after you've had that run, rather than risking the upside near term, I think not only, and that is the biggest concern, how high will rates go? I think they're going to calm. That's our base case because inflation is calming. But if they don't, that's a real problem. And in addition to that, you have, whether it's geopolitical conflict that you're worried about, you have fears about fiscal debt, government shutdown. All these things are psychological barriers that could cause PE contraction in the near term. Mm-hmm. On the good side, you got earnings that are coming out, and I think we're going to have a very good earnings season. Margins are starting to base and improve. And in that environment, as an active manager, that gets us excited when you're talking about, like Peter is, individual stocks. It's not an index, it's a market of stocks.
Yeah.
Not a stock market. So
but just to be...
that's where we're at, and we
Yeah, no, and I definitely want to talk through some of those names. They're all very, very interesting ones, some battleground names and so forth. But just to your larger point, would you say then that the surging bond yields changed your bullishness on the market?
I think it's just made us more cautious and respectful of risk. And, you know, while our base case is rates are going to calm, yeah, we're telling people, hold your ground, don't buy on the dips yet. Because if they do continue to rise further, then, you know, you need to be cautious. And I think right now, investors overall, our message is gird yourself. You know, even though we think we're going to be at 4,800 or 5,000 by mid-year next year, we could have, because of this rate rise, some, you know, nice correction. And they tend to be violent. And so gird yourself for that. Don't run away. Don't run scared because earnings are improving. But you know, you're going to have to kind of weather some volatility because of these factors.
Yeah,
that's our message.
I think that makes a lot of sense. And again, a lot of people are wondering if some kind of, you know, downward move is lurking around the corner. Obviously, you sound like you have a buying list now and you have a buying list ready. I mean, you're buying names like Tesla, like Booking, Royal Caribbean. So plenty of you know, kind of scary consumer and retail names in that mix. I could call out others. You've got some industrials on here. Technology names. You really kind of got them all. Is there anything that these companies have in common, or are they market leaders? Do you think they just have strong balance sheets right now? What are you kind of most looking for?
I think they have a combination of great earnings profiles, great growth prospects, and there are relatively And most of those stocks are attractively valued, and it's a blend of growth and value.